Hi everyone, my name's Brett and I'm the co-portfolio manager of the Bellevue Healthcare Trust. And today I'm going to sort of explain why we think now is a really compelling and interesting time to start looking back at the mid-cap healthcare space. So it's quite interesting when you look at a longer term chart that from 2003 right through to the end of October 2021, the Russell 2000 Healthcare Index, which represents basically the small and mid-cap universe within the healthcare arena, that generated an annualized outperformance of approximately 300 basis points on an annual basis over the Russell 1000 Healthcare Index. And that's obviously the large cap index. So historically, over that sort of 20-year period, mid-cap healthcare has shown a strong outperformance versus large cap. Now, what we've seen over the past 2 years is a very, very sharp reversal in that trend, where actually the mid and small cap has underperformed the large cap to a very significant extent. And you can see that in the graphic that's been shown up here. And, you know, this area highlighted in red shows that significant derating. This is only the last 10 years worth of data. But obviously what we've seen is this big opportunity as we see it open up in terms of investing back into the mid and small cap arena. And we've done a bit of dissecting around, you know, what has been driving this and we've got some very strong thoughts, as I'm sure you'd appreciate, on that topic. So if we look at the next sort of graphic, what this hopefully shows is the EV to revenue CAGR for the portfolio. So we're trying to capture valuation through the enterprise value of the holdings against the revenue expectations that we had at any given point in time. And as you can see here, we're back at 2019, 2020, 21, 22, 23, and up until today. So obviously, if you go back to 2019, you can see from that point through to the end of 2021, the portfolio in and of itself had a much higher EV to revenue CAGR. But during that period, we still managed to generate 85% absolute outperformance and over 2,500 basis points of relative outperformance. And then what we saw, and it's depicted, by the sort of falling bubbles. Obviously, we saw the valuation of the portfolio on this EV to revenue CAGR decline quite materially. And as you can see, during that period, performance for the trust was much trickier. And obviously, we've seen a 40% reduction in this EV to revenue metric. Now, what is quite interesting and telling is when you actually go into each of these data points and look at the revenue outlook, the revenue CAGR component, that has largely not moved around very much at all on a year-by-year basis. So yes, there is some fluctuation one year to another as the portfolio changes and expectations change. But by and large, we're talking, low double-digit, low teens kind of revenue CAGR. What we've seen is this significant compression in the valuation component of driven by the share prices in the market. But actually the market's expectations for the portfolio on an aggregate are largely unchanged. And that's why we feel it's a really, really interesting time to start to look again at this space, because we've seen this significant compression in valuation. Now, lots and lots of people naturally go, well, it's all about rates. And yes, clearly interest rates do have a fairly meaningful role in this derating. But I think what's quite interesting is I think a lot of people are now starting to think that, mid-cap growth, which is obviously the area that we typically invest in, you can't invest in that in a rate tightening environment. They're sort of mutually exclusive kind of events from a performance kind of point of view of the product. But actually, when you go back and look at 2017 and 2018, for example, in each of those years, the Fed actually raised interest rates 75 basis points in 2017 and 100 basis points in 2018. And in each of these years, the trust delivered positive performance. So this is not a situation where the strategy cannot perform in a rate increasing environment. I think what has been the challenge over the last 18 months, 24 months, is the speed at which rates have risen. So again, when we go back to 17 and 18, they were 75 and 100 basis point years. So that very much that typical sort of sawtooth increase that everyone is used to. Whereas obviously in this most recent tightening cycle post the pandemic, it's been far more, sort of exponential in terms of the speed and ferocity. And I think what that has led to is, investors not necessarily having confidence in understanding, well, where's the peak going to be? Is the peak, was it going to be 3? Was it going to be 4? Is it going to be 5? Is it going to be 6? That's been the narrative and the discussion. And I think that's made a lot of people wary about what's an appropriate discount rate to use for some of these growth assets. I think a lot of people got burnt badly sort of buying all of these names. And it's not just within healthcare, mid-cap growth more broadly across the market has struggled. So I think a lot of people have just sort of stepped away for a while from this area. But I think now that the discussions are evolving around, the peak rate, I think people can start feeling a lot more constructive. So what we've seen is, the rhetoric coming out of some of the central banks is now we're talking about, we're plateauing, or maybe we're going to be going back to this, very slight increments. And dare I say, more recently, people have already been talking about the Fed now considering cuts in March as an option. Obviously, 3-4 months ago, these were completely, off the table, and now they're very much coming into the mainstream in terms of discussion. So I don't think we need to see rate cuts at all for this area of the market to start to perform again. I think all we really need is people to have confidence that, right, we're very close to the peak. Yes, we might go up another 25, 50, 75 basis points, but we're not going up another 2 or 3 or 400 or anything like that, which has been, suggested in the past. And I think if people get that confidence, what they can then start doing is reevaluating what kind of discount rate, either a peak or a trough or a through the cycle discount rate, is appropriate for many of these names. And then obviously you can start having some potentially more constructive views around this valuation gap that has opened up and indeed it closing in due course. The obvious interesting thing about this point where we are in the economic cycle is, the demand for healthcare is completely decoupled from the economic cycle. Unfortunately, if GDP is +5 or -5%, it doesn't matter. People will still get sick. People will still need to access the healthcare system. People will still consume the products that the companies that we invest in obviously offer. And that sort of plays back to the point I made earlier around when you look at 2019, the growth outlook of the portfolio has remained largely unchanged throughout that entire period, because again, healthcare demand is completely decoupled from economic activity. So, hopefully, we started seeing it in the past few weeks. Certainly through the month of November, and that's continuing to where we are here in mid-December, that the valuations of mid-cap healthcare is certainly catching up its larger brethren in a significant way. And obviously the trust is now also benefiting from that. And we feel, very positive about the outlook going into 2024.